Wall Street is in a panic. The titans of finance, banking empires that have stood for centuries, are genuinely terrified. A multi-trillion-dollar nightmare is unfolding, and it's not coming from a typical economic crisis. It's coming from a type of digital currency you probably hear about every day: stablecoins. With the US Congress having just passed a historic piece of legislation, the Genius Act, the first legal framework for stablecoins is now in place. And immediately, a wave of alarm, even fear, is surging through the entire banking industry. So, why are they panicking? What could possibly have the most powerful financial institutions on the planet on the edge of their seats? This isn't just a story about technology. This is a story about power, about the flow of money, and about a revolution that could reshape the entire global economy. And most importantly, how will it directly affect your wallet? In today's video, we're going to break it all down. You'll want to stick around until the very end, because what we're about to reveal could completely change the way you think about money. Welcome back to Pie From Us. Before we dive into that earthquake, we need to understand the culprit. What exactly is a stablecoin? Forget the wild price swings of Bitcoin or Ethereum. Imagine you have a US dollar, but instead of being in your leather wallet, it's in a digital wallet on your phone. It's still a dollar, its value is still a dollar, but it has been digitized. That's the core idea of a stablecoin. Basically, a stablecoin is a digital asset designed to hold a stable value by pegging it to a real-world asset, most commonly the US dollar. The biggest players in this market, which you've probably heard of, include Tether, also known as USDT, and USD Coin, or USDC. Right now, with a total market cap already over $150 billion, stablecoins are mainly used as a way station in the crypto world. Traders use them to lock in profits without converting back to fiat currency or to trade between different coins. But that's just the tip of the iceberg. Their true potential is so much bigger. Think about sending money internationally. Currently, if you want to send money from the US to Vietnam through a bank, how long does it take? 2, 3, maybe even 5 business days? And the cost? It can be as high as 5 to 7% of the total amount. With stablecoins, that same transaction can take just a few minutes for a fee that's next to nothing, regardless of whether it's day or night, a weekend, or a holiday. It's convenient, flexible, and incredibly efficient. Stablecoin is essentially $2.0. And this, right here, is where the bank's nightmare begins. To understand why the banks are so scared, you need to understand how they make money. It's simple. You deposit money in a bank, right? That's called a customer deposit. The bank doesn't just lock that money in a vault, they use your money to lend to others, loaning to businesses to expand, to individuals to buy homes and cars. The interest from these loans is their bloodline. It's the heart of the banking business and the engine for economic growth. Your deposits are the blood that keeps the system alive. So what happens when that blood supply is suddenly drained? A shocking report from the US Treasury dropped a number that sent a chill down Wall Street's spine. If stablecoins were to be widely adopted as a tool for payments and savings, the banking system could witness a deposit outflow of up to $6.6 trillion. To put that number in perspective, it's more than the GDP of Japan and Germany combined. It's equivalent to about 1/3 of all deposits in all US commercial banks. This isn't just a crack in the dam, this is a flood that could overwhelm the entire system. Why would people pull their money out? Put yourself in the user's shoes. On one hand, you have a bank account, where you can only transact during business hours, interbank transfers take time, and international transfers are both slow and expensive. On the other hand, you have a stablecoin wallet, where you can send and receive money 24/7 in seconds for a dirt cheap fee.
The choice is obvious. When millions, then tens of millions of people move their money out of bank accounts to hold stablecoins, the bank's ability to lend will be strangled. The capital available to the economy shrinks. It becomes harder for businesses to get loans, harder for people to buy homes. A full-blown credit crunch could absolutely happen. The banks might argue, okay, stablecoins are convenient, but we pay interest on deposits, and stablecoins don't. People won't be foolish enough to hold a non-yielding asset. And this is where things get really interesting. The Genius Act, in an effort to protect the banks, included a clear provision. It forbids stablecoin issuers like Circle or Tether from paying interest directly to token holders. In theory, this should eliminate a major competitive advantage. But in the world of fintech, there are always clever workarounds. Instead of paying interest, These companies partner with exchanges to offer rewards programs. In a sense, they are one and the same. Let's look at the most prominent example. Coinbase, one of the world's largest crypto exchanges, is offering a rewards program of up to 4.10% APY for customers holding USDC, the stablecoin issued by Circle. Meanwhile, what's the average interest rate on a savings account at a major US bank right now? About 0.45%. That's nearly a 10x difference. Coinbase can argue that this is their independent program, not paid by Circle, but to the end user, that doesn't matter. The result is they are holding an asset that's as stable as a dollar, as flexible as crypto, and earns yields like a top-tier savings account. This is the killer blow. Stablecoins suddenly look exactly like a supercharged version of a bank account, but without being tied down by the same strict regulations. This competition was never fair to begin with. Banks are being forced to compete with one hand tied behind their back. They must comply with a host of incredibly strict regulations designed to protect the financial system. They must have reserve requirements, meaning they have to hold back a portion of deposits and can't lend it out. They must participate in the Federal Deposit Insurance Corporation, which insures each customer up to $250,000 if the bank fails. They have to meet strict liquidity requirements. Meanwhile, what about stablecoin issuers like Circle and Tether? Right now, they operate in a legal gray area with a much lower level of oversight. This creates a massive systemic risk. Picture this scenario. You withdraw $500,000 from your FDIC-insured bank account to buy USDC. Circle, the issuer of USDC, takes your $500,000 and does what? They don't lend it out like a bank. They typically invest it in safe assets like US Treasury bonds or deposit that money into a single large corporate bank account. The problem is, Circle's corporate bank account might hold billions of dollars, far exceeding the $250,000 FDIC insurance limit. If the bank holding Circle's assets fails, or if there's a crisis of confidence that causes a mass run on USDC, who insures your money? The answer is nobody. The migration of trillions of dollars from a highly regulated, insured system to a less supervised, underinsured one is an extremely dangerous gamble with the stability of the entire financial system. But wait, the story doesn't end there. The picture gets much more complex and frightening when the tech giants decide to enter the game. The Wall Street Journal has reported that corporations like Amazon and Walmart are seriously considering issuing their own stablecoins. Now, just pause and think about that for a second. Amazon has over 300 million customers worldwide. Walmart is the largest retailer on the planet. What happens if they launch an Amazon dollar or a Walmart coin? You could get your paycheck deposited directly into your Amazon digital wallet. You'd use it to shop on the website, pay at Whole Foods, subscribe to Prime Video. You'd save and earn rewards right in that wallet. Your entire financial life would take place within a single ecosystem without ever needing to step foot in a traditional bank again.
This is the threat of debanking on a massive scale. It wouldn't just drain deposits, it would completely erase the bank from the daily lives of millions of consumers. The flow of money would be concentrated in the hands of a few giant, uninsured tech corporations, creating an unprecedented concentration of financial power and risk. Facing the threat of extinction, the banks are, of course, not sitting idly by. They're fighting back. Some of the biggest names in American banking have started planning a classic strategy. If you can't beat them, join them. They are forming consortiums to issue their own stablecoins. JPM Chase has already pioneered this with its JPM coin used for internal settlements. Now they're looking to expand it to corporate clients. This way, they can both compete directly with other stablecoins and keep customers and their money within their own ecosystem. Beyond that, they're also exploring a new role in the stablecoin value chain. Instead of being competitors, they could become indispensable partners. They could offer custody services for stablecoin issuers' reserves, or act as the secure, licensed bridge for converting between stablecoins and the traditional fiat system. The war is far from over, but one thing is certain, the rise of stablecoins is not merely a technological advancement, it is a deafening alarm bell, warning that the role of financial intermediary, which banks have monopolized for centuries, is being shaken to its very core. Ladies and gentlemen, what we are witnessing is just the beginning of a completely new journey for blockchain technology. The Wild West era, where anything goes, is coming to an end. With legislation like the Genius Act, cryptocurrency will no longer be an outlaw. Instead, it will be integrated into the system, protected and shaped by the law. From now on, every project will have to prioritize legal compliance, especially compliance with the laws of the US, the world's financial center. Any project that ignores this will gradually be phased out. And this brings us to a very unique project, a project that for years has been quietly building its legal and compliance foundation, even as it was criticized by many for being too slow. That project is Pi Network. Pi Network can be considered the project with the best legal and know your customer framework among crypto projects today. While many other projects chased quick price pumps, Pi Network has spent 6 years meticulously building a solid foundation, a massive community, and a robust compliance system. This is the necessary and sufficient element for it to explode in the future, in the new era we've just analyzed, an era where legal compliance is the most important ticket to the game. Of course, patience is required. The stronger the foundation, the more time it takes to build. It might take another 2 to 3 years before we see the true value of PiCoin recognized by the market, perhaps at a level of $5 or more, once it has fully integrated all the elements of technology, ecosystem, and especially legal standing. So what do you think? Can the stablecoin earthquake truly sink the banks? Is this the end of their era of dominance? And do you believe that meticulous legal preparation is the key to success for projects like Pi Network in the future? Let us know your thoughts in the comments below. We'd love to hear what the community thinks. If you found this video helpful and informative, don't forget to hit that like button, subscribe to Pi from us, and hit that notification bell so you don't miss any of our future deep dives. Thank you for watching. We'll see you in the next one.